see. Part to Papa. Yeah, so it should be working there. I think we shall see. I saw a thing before I did my last video. It said chat's not on, but it looks like it's on here. So if you want to ask a question, fire away for sure. All right, so it's 7:30. Welcome to Heritage Wealth Planning, my friends. Today we're going to talk about term life insurance, the real basic stuff. And just because it's basic to me doesn't mean it needs to be basic to you. As if you don't. If you don't know it, that's fine. You got to learn somehow. And I'm going to teach you everything you need to know about term, because it's actually quite simple, frankly, once you understand. But I'm also going to share with you a couple of things you need to be looking at as well in terms of if you're looking at buying a term life insurance policy, the things you need to be looking at, because I'm telling you, you can make this huge mistake, and particularly one jumps out of mind that you got to avoid. So term. We're not talking permanent. We're not talking a whole life or a universal life. I'll do that on another video. I'll probably do that tomorrow, as a matter of fact, to tell you about whole life and then tell you about universal life. Term is temporary insurance. You are paying a fixed amount of money, a premium, for a temporary amount of life insurance coverage. That's it. It could not be any simpler. There's a unilateral contract. That means there's only one obligated party, and that is the insurance company to pay you as long as you've been paying your premiums. You can stop at any time you want whatsoever. You're not under any obligation. There's no contract on your end. You can quit after 2 days. You can quit after 20 years. It does not matter. The insurance company has a unilateral contract to make sure that if you die and you've been paying the premium and your policy is still active, they will pay you out. That is a fact, what happens with term life insurance, which makes it a one-way street. But to get on that one-way street, you have to go through underwriting. And that's where the insurance company can really hit you pretty hard on the front end to make sure they're not taking a big risk. Because remember, at the end of the day, term life insurance is incredibly inexpensive. It's just doggone cheap. And so if the insurance company isn't protecting their bottom line and they're just giving away like they used to do mortgages to ninjas, and ninjas was a no income, no jobs or asset loans that they used to do in 2005 and 6, which led to the financial debacle that we had in 2007 and 8. If insurance companies did the same thing to underwrite life insured, the insured, what's going to happen is then all these guys are going to die. The insurance company didn't raise enough money, and it's not going to work. Insurance is the one area, too, that you have to have an explicit trust in the company. I mean, that's like you see Northwestern Mutual, New York Life, USAA, all these TIA Craft, all these firms have been around for a long, long time. They have to be, because you got to make sure that you put all that money in for years and years and years, that when you die, that money is going to be paid to your heirs. You have to. If you don't expect that to happen, no one's going to buy insurance. And insurance companies can't have that. So they're going to be very, very conservative, very cautious. Did you know the largest holder of bonds is insurance companies? Interesting, huh? Government bonds in particular. Why is that? Because they want to make sure that if the markets fall 25, 30, 45%, they don't get hammered if they have a lot of obligations they got to pay out. So the biggest and one of the biggest, safest group of investors are insurance companies. They're going to be buying those bonds, government bonds in particular, highly rated corporate bonds, to make sure at the end of the day that they will have the money in their net worth statement to make sure they can pay it out once I die. All right, so a term life insurance policy, what happens is you get like a 10, a 20, or 30 year. And I'm just going to go with those three. You can do whatever you want, but 10, 20, and 30. Generally speaking, what I tell people is I say, look, get enough to cover you till you're about 60, or unless the mortgage is paid off. So let's give me an example. I'm 48. Let's say I'm 50. I get a $400,000 mortgage. We'll say I want to get a $500,000 term policy, all right, or $400,000. I'll share with you why I say $500,000 in just a second. I want to get enough life insurance to cover me until I'm about 60, maybe even 65. For a 48-year-old man, that won't be that cheap, actually. That's for that much money. That probably running me $120, $150 a month, probably. And I just don't know for sure, but it would not be that cheap, I wouldn't think. Actually, frankly, I don't know. Maybe $100 a month. It's still pretty significantly cheap for the amount of insurance I have. But basically what you're saying is at the end of the day, I'm going to spend $100 a month. The insurance company is going to give my wife or my kids or the church or whoever $400,000 a month at my death. In this case, my wife, she'll get that $400,000. She'll pay off the mortgage. Generally speaking, that's what I tell people. You should always have enough insurance to at least cover the mortgage without question. But now think about it. If I die and she has enough just to pay off the mortgage, well, she loses my income. I mean, so hopefully she'll have an IRA, 401k, or some other asset, but she loses the income. So the only way she's going to get that income is by going to work, or, I mean, so we want to have more than just enough to pay off the mortgage. But generally speaking, at the end of the day, you want at least enough to pay off the mortgage. Now, you usually can get in bands, so 100,000, 250, or 500. Generally speaking, at least in my previous firm at USAA, is that a $200,000 policy was more expensive than a $250,000 policy, simply because it's all done, almost AI, artificial intelligence. They say 100,000, 250, 500 million. It's just that simple. So you don't need a $429,800 life insurance. Just get $500,000. Probably is going to be cheaper than 450 or 425. So just think 255 and a mil, 255 and a mil. Anytime you break the mill to 7 figures, the underwriting is a little bit significantly more stringent. They're going to do EKGs. They're going to get your physician statements and look at it every which way to Sunday. So just keep in mind, anytime you break that $1 million threshold, 7 figures on life insurance, you will be subject to a lot more underwriting. They're going to look at deeper. There's just no other way around that. So a $500,000 20-year life insurance, it's not that difficult to get. They're still going to take your blood. You're still going to have to pee in a cup. They want to make sure you're not drinking, doing drugs. They're going to check for nicotine in your blood. They're going to check for just blood work, your triglycerides, your LDLs, your HDLs, your BMI. I mean, all that stuff is silly. Triglycerides has a little bit more chops when it comes to your ability to maintain from a heart attack. Low LDL is a bad LDL. HDL is a good LDL. There's really no evidence anymore that LDL on a low side is good, or it doesn't matter. High HDL, they like to see it for sure. The evidence is somewhat sparse, but triglycerides are a pretty significant one. So if your triglycerides are high, that's going to hurt you, because that means you're more likely to have a heart attack. I'll give you an example. When I did my episode just a couple of hours ago, I talked about how I had high triglycerides. My triglycerides like 320 or something like that. It's it was off the charts, and they weren't going to underwrite me very well at all. So what I did is I went on a low carb diet. Low carb diet, lost a lot of weight real quick, didn't eat any carbs and any sugars. And I went back and got underwritten again. 4 or 5 months later, I lost probably 25 pounds. My triglycerides went from like 320 down to like 90 or something like that. My HDL stayed flat. My HDL was up and my LDL was up. That's what it was, because I ate a lot of eggs and bacon and no carbs, but lots of proteins, lots of cholesterol. And nowadays we don't worry so much about cholesterol because it's silly, but in the old days they did. But nowadays the high cholesterol doesn't matter, because the eggs are wonderful. They're the super food. And if you're going to eat eggs, you're going to get higher cholesterol, which is both HDL and LDL. So those will both go up. So triglycerides, that you really got to watch yourself, because that's actually like the carbs, the sugars and whatnot. All right, so that's what I did. And after about 6 months or so, and I lost all that weight, I revisited and got $1 million life insurance through a company that deals with folks who do exercise. And I'm drawing a blank on the name of the company, man. Health IQ, that's what it's called. So basically for me, because I do like to work out, they asked me questions about weightlifting, about squats and deadlifts and things like that nature, just to make sure that if my BMI was obese, like what USAA said, that's truly attributed to working out. And if you answer the questions correctly, for squats, deadlifts, that's what weightlifters do. They'll know. They'll say, okay, that this guy is definitely, at least he's knowledgeable enough that we don't have to worry about the BMI. USA, on the other hand, they said, oh, your BMI is too high, we're going to rate you as obese. And that's just silly. I'm not obese. I just, my thighs are kind of big because I like to do squats. And so because of that, I got dinged from USA. My triglycerides had dropped, which was wonderful, but Health IQ did great. They said, okay, yeah, your BMI is high, but we don't care about that. We care more about your knowledge of weightlifting. We certainly care more about your triglycerides and your weight as well. And because those things are under control, you're going to get the best rate. And that was wonderful. And so if you're a bike rider, a jogger, if you lift weights, anything that's triathletic, your term that you're applying for and put in realistic concerns, not BMI, it's just Health IQ, wonderful, wonderful place, where a lot of other firms don't do that. They just look at your straight numbers, BMI, triglycerides, HDL and LDL, and that's all silly. All right. So once you get underwritten, if you're going to get underwritten, I'm just telling you, let's just say you go out hanging out with the friends and you're smoking a cigarette on the nights out at the bar. I'm just telling you, don't do that. Don't do that right before you get underwritten. That nicotine gets in your blood and you're going to pee in a cup where you're going to take the blood work and they're going to see nicotine and they're going to say you're a smoker. And you say, I don't smoke. They don't care. They just are looking at it as explicitly, as quickly as they can. If they see nicotine in your system, you're a smoker. And right then you just doomed yourself. Don't do that. I don't smoke, I don't drink. All right. So I have a long time ago. I don't do it anymore. But if you're going to do that and you're going to get underwritten, don't do it. We're talking hundreds of dollars a month difference here between a guy or a lady who doesn't smoke and a guy or a lady who does. And doesn't smoke is someone who has no nicotine in their blood and alcohol, blood and urine. Someone who does smoke is someone who has nicotine, which means, again, just hanging out at the bar that night and you're smoking up a couple smokes as you're drinking some beers, and now next thing you know, you're going to get underwritten. Just don't do that. Secondly, don't volunteer anything. I can't tell you how many people have made this mistake when I've sent them to get underwritten. They're going to ask you a bunch of questions. Just answer the questions yes or no. Do not volunteer anything. What's going to happen is you're going to get this lady on the phone. I've never had a man ask me. They're going to ask you, they're going to fire, boom, 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 boom. Fire away all these questions at you about being underwritten for life insurance. Yes or no? Half time, don't even understand what the heck she's talking about because she's talking so fast. She's literally reading from a script. Blah, 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 blah. They're just don't volunteer. Don't say, well, back in 1996, I did have a smoke. No. If they ask you questions, answer yes, answer truthfully. Don't lie, but don't give them anything more than they need to find out. Thirdly, they're going to ask for your physician statements. This is always a pain in the butt. These doctors' offices hate giving you their what's called a APS, annual physician statement. And that's always going to be a problem. So you're going to have to tell your physician, your primary care provider, say, hey, look, I'm trying to get underwritten for some life insurance. Can you at least get the stuff out there to them when the life insurance company calls you? They might charge you a fee of $5, whatever, and just pay the stupid thing. But you got to get that done. And on top of that, go ahead and get a physical from your physician anyway, because a lot of times these companies nowadays, they want a health for when it comes to health insurance. They want to make sure you're in good shape on your triglycerides, on your blood, your blood work, on your urine samples, on your LDLs and HDLs. So if you're going to get your life insurance and your blood drawn, go ahead and say, hey, by the way, might as well get a physical drawn up too, so you can get that to your employer. They might give you discounts there as well. So when it comes to underwriting, I'm telling you right now, the big thing you can do is make sure you are in as tip-top shape as you can be. Don't go splurging the night before on cigarettes. Don't go splurging the week before on ice cream. Try to lose a couple pounds. Don't smoke cigarettes. Don't drink beer. Just go and try to be, what's the word I'm looking for? Sober, but not sober like you're drunk, but just, even keel. I don't know what the word is. Try to get your underwriting as best you can. That will help you immensely for getting your life insurance approved. And it'll help you immensely for not only getting approved, but getting it cheap as well. All right. So now what happens? Another critical thing on term life insurance, you got to find out if it has a conversion option. What this means is after your term is up, so let me give you an example. You have a 20-year fixed rate term. You pay $100 a month for 20 years. You got $250,000 life insurance. So you pay $100 each and every month for 20 years. If you die within those 20 years, your spouse gets that $250,000 back. Tax-free, not back, but tax-free. That's how life insurance works. What happens in year 19, though? Well, you're about a year out from your life insurance not expiring. Because what happens with term is it doesn't go away. It just the premiums go, they jump like that. They go through the roof. Premiums on life insurance jump through the roof simply because now you're in year 21. And then it's become a annual renewable term. And what that simply means is they're going to give you the rate for your age at that time. You're no longer locked in. Now it's almost like a adjustable rate mortgage that adjusts every year. All right. So what happens now is year 21 is still not, it's going to be a lot more expensive than it was, but still somewhat affordable. But you don't want that. You want to see if it has a conversion option in there. What that means is you can convert a portion of your life insurance to a universal or whole life insurance. And again, I'm not going to get into universal and whole life insurance today, but just remember a universal or whole life is a way you can take a term policy, put it into a universal or whole life that will cover you literally for your whole life. We don't have to be underwritten again. And so just remember a convertibility. If you get term insurance, the first thing you ask is, does this have a convertibility option on it? Can I convert it to a universal or whole life without being underwritten again? If they say no, say, I don't want that. I want to get something else. I'm telling you, I've seen it with my very eyes. People say they didn't think they were going to need the life insurance anymore, but then they get a debilitating illness or something like that. They only got 2 years left on the policy, and they can't get any new on life insurance. And then when the policy, again, a term policy doesn't expire, it just becomes annual renewable, which means the premiums just jump each and every year. And as I talked about in my previous videos, it gets pretty pricey there to the point it's not affordable. And so now you got some lady who's got, breast cancer, all right? And she's like, man, I still got a mortgage. I don't want to leave this debt with my husband and kids, and this life insurance is going to go away before I do. What are my options? And she calls the life insurance provider and she goes, hey, do I have the convertibility option to put this to a permanent policy? And they say, no. That's just the wrong answer. And I mean, there are policies that don't offer convertibility policy on the front end. You got to make sure you find out what it is. And if you have it, does it have the convertibility option for you to be able to get life insurance without going through underwriting again? Another reason convertibility is so critically important. Remember, you take the life insurance, like let's say you took it when you're 35 years old. You got a 20-year term. You took it when you're 35. Now you fast forward 20 years. Now you're 55. You're probably heavier. You're probably not in good shape. You're older, which means you're closer to death. I know it sounds morbid, but we're dealing with life insurance. Guess what? Your convertibility on that policy is based on your underwriting when you're 35. All right. I cannot stress that enough. It means it's going to be as cheap as it was when you were 35 years old. It is not based on your underwriting as a 55-year-old man or woman. It's based on when you're underwritten when you're 35. So let me give an example. 35 years old, you're in tip-top shape, and you're a triathlon, whatever. You got the premium rate, premium plus, premium ultra is what we call that USA, PUL, which is like the Superman rate. And not that many people got that, like 10 or 15%. But you got the PUL, ultra premium. I forgot what it's called. PUL. Anyway, it's called PUL, premium ultra. Anyway, and so now you fast forward 20 years, and now maybe you start smoking. Maybe you got 100 pounds on you. Maybe you got heart disease, whatever. Guess what? You can still convert it, not based on who you are as a 55-year-old, it's based on who you were as a 35-year-old. Significantly cheaper. Your premium, your preferred ultra, PUL preferred ultra, the rating on that is so much lower in terms of the fees, the contract, the premiums than the rating on anything else. And so you are basically getting your PUL rating, even though you are down here. It's just wonderful. So the convertibility option is wonderful. Now, a lot of people say, I hate life insurance or whole life or term or universal life. I don't care. I don't care if you hate it or not. The facts are, if you need it, you're going to be certainly glad you have the convertibility option. I'm telling you right now. So a couple things. When you're going to be underwritten, don't smoke, don't drink, try to lose some pounds, all that stuff. Don't volunteer anything. They don't ask. Find out, does it have a convertibility option? If it doesn't have a convertibility option, walk away. Now, they might say, well, it costs a few more bucks to have a convertibility option. Fine. I mean, if it's a couple more bucks, it's absolutely fine to have the option to turn it to a permanent policy later on in case you need it. You might not need it and then just let it lapse. That's fine. But if you need it, you're going to be glad you did. I've been through there many, many, many times where people say, man, I wish I had some insurance because I have a lot more debt than I thought. And I thought that insurance would be gone. That debt would be gone by the time the insurance was. You don't want that. All right. So another thing about term life insurance, a lot of people, they forget to change the beneficiaries. If you die, the person who gets the money is the person named as your beneficiary, bar none. It doesn't go through your will. It doesn't go to probate. It is whoever you named as your beneficiary is going to get that policy. And so if you're on your second spouse and you still have your first spouse as the primary beneficiary, guess what? Your first spouse is getting it. And if your first spouse is just a loser and you can't stand him or her to get the money, it does not matter. Your first spouse is getting it because you haven't updated your beneficiary. I cannot tell you how many people don't do that. So with term life insurance, again, the likelihood of you dying with term life is pretty minimal. But if you do, you got to make sure that beneficiary designation is updated. Just look at it once a year. If I die, who gets this policy? Oh, it's, her. No. Can't have that. I want him to get it. No. Don't have him. I want my new husband, whatever. I don't care. Whatever it is. You can always name anyone you want. You can name me it doesn't matter. whoever gets the policy is a primary, you got to name as primary beneficiary. And then there should be contingent beneficiaries, i.e. I put my wife Charlotte as primary beneficiary. If she dies before I do, and then I die, and I forgot to take her name off as primary beneficiary, there'll be contingent beneficiary, which would be my kids. You got to have that as well, because if you don't, it's going to go into your estate, which means it's a probated asset. Not the worst thing to ever happen, but we'd like to avoid probate if all possible. So what you want to do is make sure your beneficiary designations are up to date. It will avoid probate. Your will has nothing to do with this, nothing to do with it. Probate has nothing to do with it. It just goes directly to the person you want to get the money. And it's tax-free. But remember, for life insurance, you got to avoid the unholy trinity of three things: the insured, as the beneficiary, and the payor. All right. So you do not want three different people here. So you have the insured, me, the beneficiary would be my wife, and I'm the payor. So that means I'm paying for the contract. I'm the insured. And when I die, my wife gets it. That's fine. If I have the insured as me, or the insured as my wife, the payor as me, and the beneficiary, my uncle, that's a no-go. That's a gift at my death. And so it's unholy trinity. You just got to remember, you don't want three different people involved here. You just want two people. You do not want the insured, the payor, the owner. And I should explain that. We're going to assume the payor, the person's paying the premiums, is the owner. So you don't want the owner, the insured, and the beneficiary being three different people. If you do, that means it will be a gift at the death of the insured. That's kind of complex, but just remember that in the back of your mind. You don't want that to happen, because life insurance will transfer tax-free at the death of the insured, but it will be subject to gift tax if those three people are different. The unholy trinity. You don't want that. So I cannot stress that enough. The insured, the beneficiary, and the owner, the two of those people have got to be the same person without question. Okay. And so that's just got to be like that. What else? You don't have life insurance, term life insurance for really estate planning. A lot of people say I'm going to get a life insurance policy for estate, not term. Terms, again, the vast majority of term, it doesn't survive you. It just does not. So you want to make sure if you're doing life insurance with estate planning, term is not your solution here. What else? Oh, by the way, if you have old life insurance policy and you're still in decent shape, you might want to look at refinancing. And refinance isn't really a true word, but the facts are the Society of Actuaries, the underwriting table, the actuarial tables for life expectancy now has changed significantly over the last 10 years. So what was more expensive 10 years ago is less expensive today, simply because people are living longer. More of these policies are lapsing. Less is being paid out from life insurance companies, which means there's more competitive to drop the premium. So you'd be surprised if you're in pretty good shape still, you could refinance. And again, it's not really refinancing, because you would be getting a brand spanking new policy. It would be worth your time to revisit getting a new policy, just because the rates have dropped significantly too. So if you have a rate from like 2003 or 4, and here it is 2018, I'd definitely look at getting a new policy without question. You shouldn't have to pay anything to get underwritten. Usually, if you have to pay something, then it's kind of sketchy. I don't think I'd do that. I'd go to a firm that does not charge me a fee to go through underwriting, because I don't know what the fee. I mean, literally, you're asking them for the privilege of you giving them money that they're never going to pay back to you. They shouldn't charge you a fee for that. And a lot of this stuff you can just do over the phone anymore, other than your blood work and urine sample. You still got to go pee in a cup and get your blood work. That's pretty much it on life insurance. I can't really think of a whole lot more. So just remember, term is no cash value. You don't get any refund back. The vast majority of term life insurance policies expire before you do, which means they don't pay out. Get enough to at least cover your mortgage and a couple of years of income. I'm just telling you right now, mortgage, 2 years of income. For me, I just look at it like this. If I die, my wife, I don't want her to have to go back to work the very next day. I'd like to give her at least, a year to two to kind of figure out what's going on and get her stuff together before she got to put on her work boots and go back into the office or something like that. So get enough life insurance to cover your debt and a year or two of income. If you can do that, you're in a pretty good place for sure. Make sure your life